The Interim Budget 2024-25 on February 1 will likely see the central government boost investment, while still sticking to the fiscal consolidation path. However, the country may have to wait for a demand stimulus, which is more likely to come with the full budget in July 2024 after the Lok Sabha elections.
Well, the choice between investment promotion and demand stimulus in any budget is very, very critical. Uh, and I'm aware that with very low private consumption demand, as indicated in the first advance estimates for 2023 and 24, there will be a natural inclination for the government to go in for some sort of a demand stimulus measures through the interim budget or the full budget that comes after it. But given the way the government has handled this challenge so far, it seems to me that the government will rather go in for more investment and stay true to the path of fiscal consolidation.
Private final consumption expenditure, or PFCE, is expected to rise to 60.9% of GDP in FY24, from 60.6% in FY23 in nominal terms. However, private spending growth is projected to slow down to 4.4% in FY24, from 7.5% in FY23 in real terms. This is what the first advance estimates of GDP for FY24 released by the National Statistical Office tell us. India Ratings principal economist Sunil Kumar Sinha told Business Standard that PFCE growth in FY24 would be the slowest since FY03, barring the COVID year of FY21. PFCE is a proxy for household consumption. Meanwhile, CARE Ratings chief economist Rajani Sinha also sees weak consumption growth as a concern. While the government is still likely to focus on boosting investment, Business Standard's Ruchika Chitravanshi points out that demand and investment are interlinked.
Demand and investment both are quite interlinked. Now, we have seen a lot of capex push by this government in the last 2 years, and the general expectation is that this capex push will continue. However, we are now seeing signs, and RBI also in August bulletin had cited a study that said that the private investment, private expenditure is crowding in, which was the purpose of the government push to expenditure as well. Obviously, private expenditure will also, private investment will also increase as demand increases. So, as far as demand goes, that's also something that the government has to address, and it can do so. One of the things it can do is keep the fiscal deficit lower. So now, which means what kind of capex push we will continue to see, how will government balance both these things is something we have to watch out for in the interim budget. Both are important.
The centre's post-COVID fiscal consolidation plan calls for reducing the fiscal deficit to 4.5% of GDP by FY26. The government has budgeted for a fiscal deficit of 5.9% of GDP in FY24. The fiscal deficit was 6.4% in FY23. So that its commitment to fiscal consolidation is not diluted, the government must ensure that higher investments yield the best results. Not doing so could pose a risk.
When the government increased its capital expenditure quite significantly in the last 3 years, it compromised on its fiscal consolidation plans to some extent. Now it has to bring down its fiscal deficit to 4.5% in 2025-26. If it has to do so, then it must make sure that every paisa it spends on its capital investment must get the best results, because it is, after all, compromising on its fiscal consolidation plan to some extent. It is important that government investment is directed in sectors where there is a lot of demand for investment from the private sector. And infrastructure sector is one such area where public-private participation as a mode can be encouraged.
Government capex has been leading investment growth, and the first advance estimates of GDP reveal that investment is the main driver of growth in FY24. In real terms, growth in investment demand, as represented by gross fixed capital formation or GFCF, is estimated to ease to 10.3%, from 11.4% in FY23. Meanwhile, GFCF is expected to rise to 29.8% of GDP in FY24 from 29.2% in FY23 in nominal terms. While growth in investment demand will remain the mainstay of economic recovery, analysts have warned that a broad-based recovery is still some time away, and a slowdown in investments in the second half of FY24 is expected. Heading into the interim budget, the government can bank on the continuing revenue buoyancy and a slowdown in expenditure. Nonetheless, will it seek to raise additional revenues on February 1 to increase investments?
My assessment is that the government will make its investment plans public in the interim budget, but it will refrain from announcing any measures on raising resources to fund this plan, and will defer it till the full budget to be unveiled in July 2024.
With elections around the corner, the government may wish to announce tax giveaways. This would also create a demand stimulus. But as A.K. Bhattacharya points out, convention demands that there are no tax concessions in an interim budget, even though this convention has been ignored before, like in 2019. Still, given Finance Minister Nirmala Sitharaman's record, the government will wait for the full budget to announce tax concessions.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.